payment on account, what we do is that we take the residential property gain, okay, then any loss that has been incurred before the sale of the residential property will be taken out. Then any capital loss brought forward will also be deducted. Then we deduct the annual exemption because residential properties are taxed at a higher rate than non-residential property. So it's best to reduce that taxable gain in order to pay less tax. Okay. Then that will give you the taxable gain before you tax it at 18% if it falls within the basic, or 28% if it falls within the higher. Okay. So on 31st January 2025, that is, it's supposed to be the 31st January following the end of the tax year. So you calculate the capital gains liability for the business as a whole. Then you deduct the payment on account, and then you get a tax liability. So yesterday, when we solved this, we deducted the losses and the annual exempt from the non-residential property. That is also correct, but for tax expediency, it should go from the the residential property so that you save tax. So if you come to this illustration, we are saying that Anea is a high rate taxpayer and she has the following chargeable gains and losses for the year. So capital loss on disposal of shares. So we have seen a capital loss. If you find a capital gain on the sale of a residential property, we'll take it out. We also have the capital gain disposal on shares. So this is a gain, so we don't consider it. So the gain on the disposal of the residential property. So now we have the gain of £90,000. We less the loss that was incurred prior to the sale of the residential property, which is the 5,000. We don't have any capital loss brought forward. So disposal, capital gain on residential property, capital loss on disposal of shares. Okay, we don't have anything. So here we now also deduct the annual exemption allowance, which is the 6,000. So now we are going to get 79,000 as taxable gain. And we are told that the lady is a higher rate taxpayer. So we charge the tax at 28% of the £29,000. That will give us what, please? What would that give us, please? 8,120. So this is the tax for the payment on account. Okay. When we come to the annual tax, that is when we get to the time that is supposed to make the capital gains tax. We now have to calculate the actual capital gains tax for the period. Now we have two items, residential and non-residential. So let's calculate the non-residential first. So we had a gain of £9,000. Okay. Sorry, £90,000. Now there was a loss brought forward on the shares, which is 5,000. We less it. There's also another loss here on disposal of the shares. It's also important that we less it so that we reduce the liability. Okay. So the loss that is on the 11th April 23, and there's also a loss on 11th March 24. Okay. Now what we do is that we also have to less the annual exemption allowance, which is the 6,000. Okay. When you do this, what are you going to get? $64,000. and an area we've been told is a higher rate taxpayer. So the capital gains tax for the non-residential will be £64,000 at 28%, giving us 17,920. Hey, Yusuf, are you sure? Hey, so here is 79,000. Oh, sorry, it's not 29,000. This is 79,000. So what's 28% of 79,000? Yes. So 1 minute. Let me clean this up. Yes. So it's 90,000 less 5,000 less 6,000. So 79,000. So this will give you £22,120. Okay. So when we come to the capital gains of the shares, which was done on 31st August 2023. Okay. The the gain we are told is no the gain on the shares is 28,400. So it's 28,400. We've already charged the annual exemption to the non-residential, so there wouldn't be any annual exemption. So this will also qualify as the taxable gain. Again, we also told that she's a higher rate taxpayer. So the capital gains tax is going to be 28% on 28,400, which will give us 7,952. Okay. So at the period where he's supposed to make the payment, 31st January 2025, his chargeable gains for the non-residential property is 17,920. Okay. And there's also another chargeable gain on non-residential property of 7,952. Now this he has already made a payment on account of 22,120. Okay. So what is going to be left? Are the liabilities going to be more than the payment that has been made on account or less than? So it's 3,752. That is the top up that he has to make. Let's start with capital loss today. We are done with the payment on account. Okay. So we treated trading loss in a previous session. So whenever an individual sells a chargeable asset and the proceeds are less than the cost, then there's going to be a loss. So normally the gains that we've considered so far, what we realize is that if the person sells the assets and the proceeds is like 10,000 and the cost is like 5,000, we realize that there will be a gain. Okay. So it's the gain that we take out the annual exemption allowance of 6,000 and see whether there will be a taxable gain or not. But in this situation, if the cost is 15,000 and the proceeds they got for the sale of the asset is 10,000, now there will be a loss resulting from the sale, which will give us a 5,000. So what we are saying is that the loss can be set against any capital gains in the current year. And remember, when we were calculating the capital gains, we said that you calculate the gains or losses on the sale of every asset individually. So if you have 5 assets and you sell them, you calculate the gains on asset 1, the gains or loss on asset 2, the gains on loss on asset 3, That's for asset 4 and asset 5. Okay, so it's possible for you to make a gain on asset 1, a gain on asset 2, maybe a loss on asset 3. Okay, so what we are saying is that here, because it is in the same year, the loss that you recorded in asset 3 can be offsetted against these two gains. Okay, now the loss takes precedence over the annual exemption, meaning if you have a loss of 15,000 on, let's say there's a loss here of on asset A of 5,000, and let's say you have a gain on asset B. Okay, the gain is say 10,000. Now you're supposed to offset this 5,000 against the B of 10,000. What we are saying is that somebody can say that, okay, let me first offset the annual exemption allowance of 6,000, so that there will be 4,000 left to offset this 5,000, so that there will be 1,000 outstanding. So when I offset this 5,000, I'll still have a loss of 1,000 to send to the subsequent year to offset. Okay, that is not what we are saying. You first have to offset the 5,000 loss, so the 10,000 gain that you have for asset B. You rather offset the loss from asset A, then the difference is what you charge the annual exempt to. So you realize that the annual exempt, instead of charging 6,000, you can only charge 5,000. It means that you waste 1,000 of the annual exempt amount. Okay, the annual exempt is not transferable or movable to subsequent years. It is the loss that can be done so. So you cannot choose how much of the loss you want to offset against the current year and then save some annual exempt. Now, if the gain available, so in this section, the gain for B was 10,000. It was more than enough to cover the loss of asset A. However, if the gain for B is, let's say, 3,000, it will not suffice to cover the loss of asset A. So what you can do is that you can carry the unrelieved loss forward to be charged against any capital gains in the future years. Okay, now with this one, you can choose, or you have the option of charging the annual exempt amount first before you bring to charge the loss, so you don't necessarily waste the annual exempt. Okay, now any unrelieved losses can also go forward, so it can go from year 1 to year 2. If it is not fully relieved, you go to year 3, on and on and on. So if the loss is being set against the current year, the annual exempt amount takes back the back seat. But if it's coming from the previous year, then you can charge the annual exempt before. So let's look at this illustration. Fiona and Jane made capital gains and capital losses for the years 2022, 2023 and 2023, 2024 as set out below. So for the tax year 2022, 2023, Fiona made capital gains of £15,000 and capital losses of £10,000. Jane, on the other hand, made capital gains of £7,000 and capital losses of £10,000. When we come to the tax year 2023, 2024, Fiona made capital gains of 17,500 and capital losses of 5,200. Jane also made capital gains of 16,200 and capital loss of £2,000. We are supposed to calculate the taxable gains for Fiona and Jane for both tax years and the amount of any losses carried forward at the end of the tax year 2023-2024. Okay, so let's start with the tax year 2022-2023. Okay, when we look at Fiona, okay, she had gains of 15,000. Okay, Jane Okay, let's finish with Fiona. Then she had loss of 10,000. So this is what we are saying. Because it is within the same year and there is a loss, you realize that the loss will be charged first. So now the gains, the net gains, okay, is £5,000. Then we charge the annual exempt allowance of 5,000. So you realize that we have wasted an annual exempt of 1,000. So the taxable gain for this year for Fiona is nil. There wouldn't be any tax on Fiona. Now when we come to Jane, okay, she had capital gains of 7,000 £7,000. Then she had loss in the same year of 10,000. Okay, so there's going to be a net loss, okay, of 3,000. Okay, so you realize that here too, Jane has wasted her entire annual exempt amount. So we are saying that you cannot choose to first charge a 6,000 so that you are left with 1,000 gains before you charge the loss of 10,000, so that you'll be left with a net loss of 9,000 to be carried forward to the subsequent year. No, you don't do that. If it is in the same year, you don't do that. So now when we come to the tax year 2023 2024 for Fiona, she didn't have any loss in the previous year, so there's nothing to bring forward. So in that year she had gains of 17,500 and then loss of 5,200. So there's going to be a net gain again, okay, of 12,300. Okay, this time around the net gain is big enough to utilize the entire annual exempt amount. So the annual exempt amount, which is 6,000, will be taken out. Okay, so now it will be left with a taxable gain of 6,300. Okay, now when we come to Jane for the tax year 2023-2024, we have a gain of 16,200. Are you guys with me? Okay, Gina. Okay, okay. So she had a gain of 16,200 and then she had a loss of 2,000. Okay, so there will be a net gain. Come again. Yeah, Gina, go ahead. No, that is the loss from the previous year. That is a loss for the previous year. So we'll charge the loss for the current year first. So this 2,000 is in the same year, it's in the tax year 2023-2024. But then net loss is coming from 2022-2023. So what we are saying is that the loss in the current year takes precedence. You charge that one against any gain recorded in the current year. So here the net gain is going to be 14,200. Now, the annual exempt amount in the current year will also be prioritized over any loss being brought forward from the previous year. So here we also charge the annual exempt amount of 6,000 first. So here we are not going to be left with 8,200 before we charge the loss brought forward of 3,000. So the taxable gain here is 5,200. Let's talk about transfers made between couples. So when a wife makes a transfer to the husband or vice versa, that will not attract any capital gains tax. Okay. So if the husband transfers an asset to the wife, let's say that transfer was made on 1st January 2010. Okay. Let's say the asset was bought on 1st January 2010 and was transferred to the wife 1st January 2024. The wife will be deemed as have bought the asset the time that the husband paid for it. We are not going to deem it as the wife got the transfer at the current date. So in this example, the man acquired a piece of land on 1st May 2010 at a price of £10,000. And then on 1st May 2023, that is like 13 years later, he transfers the piece of land to the wife where the market value had moved to £80,000. So under normal circumstances, for capital gains purposes, capital gains tax purposes, it should be the 80,000 market value less the 10,000 if the man had made a transfer to any other person than the wife, to the son, to the daughter, to the mother, to the father. The capital gains tax would have arisen. But because it is being made to his spouse, one, there wouldn't be any gains tax arising. So the 80,000 less the 10,000, which results in 70,000, won't attract any tax. Two, the wife will now be deemed as have acquired the property on 1st May 2010 and at a cost of £10,000. So what they are saying is that when the transfer is made, okay, the gift is made, then the tax will not arise immediately. So when the wife sells off the asset, it will now be the proceeds against the 10,000. Okay, so that's all this one is saying. So this treatment is beneficial when in the scenario we just saw, the wife does not pay any capital gains tax or is a basic rate taxpayer. So once she is paying a capital gains tax in the basic category, it will be prudent for the husband to move the asset to her so that instead of the husband paying at a higher rate, the wife will pay at a lower rate. Okay. Now it's also important if the wife does not have any capital gains at all, so that one, she'll utilize her annual exempt of the 6,000 and also pay tax at the lower rate of 10,000 if it's a non-residential property, and at a lower rate of 18% if it is a residential property. Okay. Let's look at this scenario. Greg owned a piece of land bought on 1st June 2014 for £40,000. For the tax year 2023-2024, he has taxable income of £50,000 and already has net gains of £20,000. He wants to sell this land for sales proceeds of £65,000. Now, Greg's wife is a housewife and does not have any income or capital gains of her own. Now, Greg thinks that it is wise to transfer the asset to his wife and let her sell it. So, what amount of tax will Greg and the wife save if he does this? So, first, let's calculate the tax that the couple will pay if the transfer is not made. So, if the transfer is not made, it means that Greg is the one having the land. So now we are told that Greg has a taxable income. Again, I don't know whether this was what Gina was trying to get at. There's a taxable income, there is a trading income, there's a total income. Now we are being told that it's a taxable income, meaning the total income or the net income was calculated, and then the personal allowance of 12,570 has been already taken. That resulted in the 50,000 being paid. So this is what we are going to use to determine whether the tax will be paid in the basic rate, in the basic category or the higher. Now this 50,000 has already crossed the basic, so it means that Greg is a higher rate taxpayer. Now we are told that he already has a gain of, he already has a net gain capital of 20,000. That simply means that he made some sales of several capital assets. Some were losses, some were gains, or all were gains. And when you put them together, the gain is 20,000 pounds. Okay. And we are being told that he wants to sell this land for proceeds of 65,000. Okay. So this is a net gain, a net capital gain. So it means that the annual exempt has not been taken out. If they told us it was a net taxable gain, okay, then the tax has already been, the exemption has already been taken out. So now let's add the additional gain on the land. Okay, so this is going to be the 65,000 proceeds that he will get. Then we less the cost of the land, which is 40,000. So this will give us 25,000 pounds. So the net gain again is now 45,000 pounds. And these are gains, not taxable. So we now take away the annual exempt amount of 6,000. We'll now be left with a taxable gain of 39,000 pounds. Okay. Now, because we are told that Greg is a higher rate taxpayer, the capital gains tax will be 20% on the 39,000 pounds, which will give us 7,800 pounds. Now, when we come to the point where Greg transfers the land to the wife at no capital gains tax arising, so Greg will now have the net gain of the 20,000. Then we'll charge the annual exempt amount of 6,000, giving the taxable income of 14,000. So the capital gains tax will be 20% on the 14,000 pounds, giving 2,800, right? 2,800. Is that correct? Okay, great. So now the wife, who formerly didn't have any taxable income or capital gains, now has a gain. So the proceeds, okay, to the wife. So the asset has been moved to the wife, and now the wife is the one selling it at 65,000 pounds. So the proceeds to the wife will be 65,000, and the cost, because the husband bought it at 40,000 on 1st June and even was transferred later, the cost will still stick to when it was bought on 1st June. So the 40,000 cost will still stay. So now the gain to the wife is the 25,000 that we will have. Then we charge the annual exempt of 6,000. So previously, because she didn't have any capital gains, she wasted the annual exempt, but it is now coming in beneficial here. So for the taxable gain, it will be 19,000 pounds, right? Now she doesn't have any taxable income, okay, so she will be in the basic category. So the capital gains tax will be 10% on the 19,000, which will give us 1,900. Okay, so if they do this, the total capital gains tax between the couple is 2,800 plus 4,900, which will give us 4,700. So when the asset was with Greg, it was paying a tax of 7,800. So the savings will be 7,800. Then we less what they are going to pay if the asset is moved to the wife, 4,700. Is that going to give us 3,100? Is that okay? Is that okay? Okay. Now, all this while, we've been discussing when the asset is sold wholly, the entire asset is sold off. There are situations where part of the asset is sold off, not in its entirety. That will also attract a capital gains tax to be charged. So if somebody has a two plot of land and sells one off, okay, or has 5 antique vases and sells 2 off, okay, because the asset was bought together and it had one cost. So maybe when they bought the 2 pieces of land or they bought 2 acres of land, they paid a price for it. Okay, so if the 2 pieces of land, let's say, was costing $100,000, let's say £100,000, so 2 acres of land is giving you £100,000. That's what they paid for. It's not like they bought one at 50,000 and they bought the other at 50,000. That way it will be easier. But because they bought them together, or they even bought one piece of land at £100,000, and now they are selling off a quarter, we need to be able to determine the cost component that we should attribute to the one that is being sold off. So if you bought 2 acres of land and we are selling one off, how much cost is the one being sold off going to bear? So that we compare it with the proceeds and then arrive at the gain. With the antique vases, maybe the vase comes together and you paid for it. So it comes in a box and you paid for one cost for it, let's say £10,000. They are now selling 2. The 2 must be given a cost. That is what we call the allowable cost in order for you to arrive at the taxable gain. So the cost for the entire asset must be given to the asset. Okay, that is what we call the allowable cost. So this is what is going to be taken away from the proceeds to arrive at the capital gains. Now, in order to determine the allowable cost to be attributed to the disposing part of the asset, the formula will be the original cost of the asset as a whole, so the 2 acres of the land or 5 vases, times A divided by A plus B, where A is the disposal proceeds that you receive from the part of the asset that is being sold, and B is the market value of the part that is not sold. So the part that is not sold will always be given in the question. Okay, so if you look at this illustration, Peter buys a house for £26,000 in October 2000. Now he has never lived in the house as his main residence. So he sells the garden for £100,000 in August 2023, incurring selling cost of £1,000. The value of the remaining house in August 2023 is £160,000. So we are supposed to calculate the taxable gain that will arise on the sale. Okay, so Peter had a house and the house came with a garden. He is now selling off the garden. The garden was inclusive of the house and it costed 26,000 to buy. Now that he's selling off the garden, he's getting money for £100,000. Now, what portion of the £26,000 is attributed to the garden? So that we take that out from the 100,000 and the 1,000 to get the gain. Okay, so in order to get the allowable cost, we are told that it will be the original cost of the asset. The original cost of the asset is £26,000. That is what was paid for the total asset. Now, the proceeds of the garden which is being sold off is £100,000. Okay, so now that is giving us £100,000. We are now going to divide it by the proceeds. So the proceeds is basically the value, the market value of the asset being sold off. We are now going to divide it by the proceeds of the amounts, the proceeds of the part being sold off, plus the market value of the part left. So the market value of the house being not being sold is 160,000. So 160,000 here. So this is going to give us 26,000 times 100,000 divided by 260,000. What is that going to give us, please? So we should get £10,000. So it means that of the £26,000 that serves as the cost of the building and the garden, 10,000 out of it stands as the cost of the garden. So if you're supposed to calculate the taxable gain for the garden, okay, the one being sold off, so the proceeds being received is the £100,000. Okay, we are being told that he's going to incur £1,000 for selling, so selling cost will be the £1,000. Okay, then that will give us net gain of 99,000. That's the net proceeds. Sorry, net proceeds of 99,000. Then we now less the cost, which is this 10,000. £10,000, which will give us the gain of £89,000. Then we less annual exempt allowance, 6,000. That will give us 83,000. So this is the taxable gain. So that's what the question is asking from us. So if out of this 26,000, 10,000 of it serves as the cost of the garden, it means that 16,000, which is the 26,000 less the 10,000, will be the cost of the building which is not sold. So whenever the building is sold off, it will be the proceeds less this 16,000, and then you determine the gain. So in this question, if the remainder of the house was disposed of for 120,000 after 1 year, you're supposed to calculate the taxable gain that will arise. So we are being told that the proceeds for the remainder of the house is £120,000. Okay, so now the cost of the house is going to be £16,000, which is the original cost of the building and the garden, which was £26,000, less the 10,000 of the garden that was sold. Okay, so the building now has a cost of 16,000. We don't have any incidental cost of sale, so now the gain will now be 104,000. Okay, then we take away the annual exempt amount of 6,000, giving us the taxable gain of 98,000. Do we get it, please? Are we okay? Hello? All right. Now, all this while we've been talking about selling the asset. Selling the asset. What happens when the asset is not sold but it is damaged? Okay. So when a chargeable asset is destroyed, or is lost or is damaged. Okay, and the value of the assets is very negligible. So the asset that has been damaged, maybe by fire or the machine fell or something has been taken out of it and it's no longer usable. Then if how much you get to sell the value or how much the value is rated is negligible, then the person can make a negligible value claim. A negligible value claim is where the asset will be deemed to have been sold off, okay, but it still stays with the business, and then realize the capital loss. So if the asset was bought for, let's say, £100,000, and then something it catches fire and then loses its value, and now if you sell the asset, you're going to get like £500. This is very negligible compared to the value of the asset. So what the negligible value claim is saying that you now treat the asset to have been sold off. Meanwhile, it's still sitting in your business. But what you do is that you claim a capital loss. Okay, so that will be the cost of the asset less the negligible value. Okay, that will be the capital loss. So as you mentioned, the capital don't have to be sold off. You are just claiming the loss upfront. So in future, when the asset is sold off, okay, it will be the proceeds less the negligible value to determine the cost. So even when you're determining the loss, you can even treat it as zero because the negligible claim, you are not getting any money from it. You don't have a sure way of determining how much you get for it. So the capital loss will just be the total of the cost. So when in future you sell off the asset, then it will be the proceed that you receive less the negligible value, asset cost. Okay. So let's look at this illustration. A painting was acquired 10,000. A painting was acquired for £10,000 and damaged in a fire. It is now worth a negligible amount. So how will it be treated for capital gains tax? So if it is worth a negligible amount, then the painting will have a capital loss of £10,000. That is, the cost of the negligible amount will deem it to be zero, and they will less the cost of 10,000 from it. That is how we will treat it for capital gains purposes. Okay. Now, when the asset is damaged or lost or destroyed, and here the asset was insured, so the insurance company is paying them for their loss or the asset being damaged and all that. In this situation, you are not going to make the negligible value claim. You are going to treat the insurance proceeds as a disposal, as a sales proceeds or a disposal proceeds. So that is what the cost of the asset will be taken from it to determine the gain or a loss. Okay, so the capital gains calculation will be the benefit or the proceeds that the person receives from the insurance company, and then they will less the cost of the asset that is either lost or destroyed or damaged from it to arrive at the chargeable gain. Okay, so let's look at this illustration. Holly owned a vase which was destroyed on 6th April 2022. She had paid 28,000 for it on 1st May 2015. The market value when it was destroyed was £80,000. However, she only received 68,000 of insurance proceeds in 2023. So we are supposed to calculate the taxable gain. Okay. So the asset was destroyed, so she didn't sell it. So there was a gain that came from the insurance. So we'll use the insurance proceeds, which is 68,000. And here we are not going to use the market value of the asset. It is the proceeds that we actually received from the insurance company that will be used as the cost. Okay. Then we now take away the cost of the asset, which is this £28,000. That is going to give us a chargeable gain of £40,000. and we are asked to calculate the taxable gains. So we now have to keep on and deduct the annual exempt amount of 6,000, leaving a taxable gain of 34,000. We spoke of the insurance money being received, therefore it will be treated as a sales proceeds, and then it will lead to a capital gain. Now, when the insurance money is received and then it is reinvested into another asset to replace the one that has been damaged or destroyed or lost within 12 months of receiving the proceeds, there will be an insurance rollover relief that will be enjoyed by the individual. So when we say 12 months, within 12 months of the sales proceeds, it means that after the proceeds were received, from that time to 12 months time, if it is reinvested in the replacement asset. So if they get the proceeds on 1st January 2024, they have up to 31st December 2024 to replace the assets with the proceeds that they have received. Now, if they replace the assets with the entire money received, then the entire gain will be will be delayed. Okay, it will be deferred. However, if part of the proceeds is reinvested, the portion that is not invested will be taxable for capital gains purposes. So if the proceeds that was received was 100,000 and they buy a replacement asset for 80,000, now 20,000 of the assets, which is the amount that is not reinvested, will be taxable. Okay. Now this gain is known as the gain rollover relief. Okay. So this gain rollover relief will be deducted from the cost of the replacement assets. So we'll look at it. So the replacement assets, the actual cost that was paid for, you will deduct the deferred one from it, meaning that the cost will reduce. So whenever it is being sold, it's now going to lead to a higher capital gains tax. So if original cost of the asset was 10,000, okay, and now let's say the original cost of the asset is 30,000 here. Now because 20,000, they received the proceeds of, let's say, 10,000 and they reinvested it. Okay, then the 10,000, the gain that is rolled over will be taken away from the cost. So let's say the rollover gain is 10,000. What you're saying is that the cost is now 20,000. Whenever you sell this asset, if you sell this asset for 50,000, if not for the relief, the gain would have been 20,000, which is the 50 less the 30. But because of the relief, the gain will now be 30,000. So all that you are doing is that you are just postponing the taxing of the gain into the future. You are not being exempted from it. Okay. So now the difference between the cost of the replacement assets and the gain rollover is what we call the base cost. Okay. So let's see this. So let's look at this. If the insurance proceeds received is for £1,000 and the cost of the asset is 900, meanwhile the reinvestment into the new asset is 950. Under normal circumstances, the proceeds, which is the insurance proceeds, is £1,000 and then the cost is 900. So ideally, there is supposed to be a gain arising of £100. Now, this 1,000, not all of it was reinvested. We only reinvested £950 out of it. Okay, meaning £50 has not been invested. So what we will do is that the gain that is taxable, okay, the chargeable gain will be 50. So the gain rolled over will now be 50. Okay, if they had purchased the reinvestment cost at 1,000, then this entire 100 would have been rolled over. Okay, so what we are saying is that instead of taxing the 100, we are only going to tax 50 now and then defer the taxing of the 50 to a point where the reinvestment asset is sold off. So the base cost that we're talking about, the new asset, it is costing £950. Okay. What we'll do is that we are now going to less the gain rollover of £50 from it. So now it's going to be £900 as the cost. That's what we're going to term it as the base cost. Okay. Let's look at this illustration. So in the previous question that we looked at, this one here, there was a taxable gain of 34,000. Okay. We are saying that what if Holly used the insurance proceeds to buy a replacement vase for £59,000 on 1st March 2024? What capital gain will be realizable in this case? So let's look at the insurance proceeds that Holly received. Okay, so here Holly received an insurance proceeds of 68,000. Okay, and now Holly received an insurance proceeds of 68,000. So the gain that arose from the this thing was 40,000. Okay, so the proceeds was 68,000 and the cost was 28,000. So the proceeds that we had was 68,000 and the cost is 28,000. So the gain that we had only had was 40,000. Now this 68,000, we are being told that only £59,000 was reinvested. It means that the amount that was not reinvested will be this minus this will be £9,000. Do you get it? So it means that the gain rollover is going to be the difference of 40,000 and the 9,000. So we are only going to roll over 31,000. That will lead to a chargeable gain of £9,000. Is that clear, please? So now for the new vase, the base cost will now be 50,000. No, the base cost will now be 28,000, which will be the original cost of the asset, 59,000, less the rollover relief of £31,000. So now the question is saying that Holly has disposed of that new vase after 10 years for £100,000. So you're going to use the proceeds as 100,000 and then less the base cost of 28,000 instead of the 59,000 from it. That will give us a chargeable gain of 72,000. And then we less the annual exempt amount of 6,000 from it. That will give us a taxable gain of 66,000. Let's look at the situation where the insurance proceeds, instead of it being invested in a replacement asset, it's being used to restore the asset. Okay, so when that happens and the person uses the proceeds from the insurance company and spends additional amounts to restore the asset, the base cost of the asset will now be the cost of the asset, that is the original price. We'll now take out the insurance proceeds that was received and was geared towards the restoration of the asset. Then we'll add any additional amounts spent in trying to restore the asset. That is going to be the base cost of the asset now. So whenever this asset is sold, this base cost is going to be deducted from it to get the chargeable gains. So if you look at this illustration, on 15th January 2024, a timepiece owned by Camel fell and was badly damaged. The timepiece had been purchased for £99,000. Kamal received insurance proceeds of £54,000 and he additionally spent a total of £45,000 on restoring the timepiece to working condition again. what is the base cost of this timepiece after restoration? So we are told that the asset fell. Okay, so what we are told that the cost of the asset is £99,000. Okay, and the asset fell. They got insurance proceeds from it. The insurance proceeds was used to restore it. So we'll take away the proceeds of 54,000 out. Okay, now the additional amount that was spent in the course of the restoration is 45,000. We're going to add the 45,000 to it. So now the base cost of this asset, okay, is going to be £90,000. So anytime the restored timepiece is to be disposed of, it will be the proceeds that will be received at that point, and then we less the 90,000 from it. We now come to chattel and wasting assets. So a chattel is normally a piece of a tangible, movable property. So when we say tangible, movable, it's something that you can touch, see, and move around. Okay. So normally personal possessions will be chattels. So furniture, paintings, plant and machinery that are fixed to a building are all chattels. So some chattels are not to be charged capital gains, are not to be charged tax on the capital gains. Okay. Exempt chattels are what we call, so the chattels that are not supposed to be charged capital gains tax are called wasting chattels. So for an asset to be a wasting chattel, it must have an estimated useful life of 50 years or less. Okay, so we have examples of race boats, race horses, and boats. Now, chargeable chattels are known as non-wasting chattels. Okay, so these are normally supposed to have a useful life estimated to be more than 50 years. So you have antiques, you have paintings, and stuff like that. Okay, so in the examination, when they mention a wasting chattel, you are not supposed to charge tax on it. So plant and machinery, which have a useful life of less than 50 years, under normal circumstances, is supposed to be a wasting chattel and not to be charged capital gains tax. However, if that plant and machinery has enjoyed capital allowance, that will be treated as a non-wasting chattel. So a capital gain needs to be calculated when the asset is disposed of. But when it results in a loss, it will not be allowable, meaning it will not be allowed to be taken forward and offset against any capital gains. So when there's a loss, that is it. But when there is a gain, then the tax will be charged on it. So where the loss comes up, that is where you have the balancing allowance or the balancing charge. That will be captured in that aspect. Do you get it? Now, the assets, it's possible for it to be a non-wasting chattel. There's a plenty of machine that we are talking about. That is, if it is bought and sold for less than 6,000. We'll look at that criteria very soon. Okay. Now, there are special rules to determine whether a chargeable gain or a loss will arise on the sale of a chargeable asset. So this is what we call the anti-avoidance rules. So, for one, when the cost of the asset is less or equal to £6,000 and the proceeds for the asset when it is sold is also less or equal to £6,000, that asset will be exempted from capital gains tax. So if you buy an asset for, let's say, 5,000 and you sell it for 5,500, the proceeds of the gain of 500 will not suffer capital gains tax. Secondly, when the asset is bought for 6,000 or less, however, it is sold for more than 6,000, okay, then the normal calculation will be done. That is where you do the proceeds less the cost. That is the normal calculation. However, the gain that you achieve, you restrict it to five thirds of the gross proceeds less 6,000. Okay, so if you sell the asset for, let's say, 7,000, okay, and the cost of the asset is, let's say, 4,000, you're going to get 3,000 as the gain. Okay, however, if you do 5/3 of the gross proceeds is 7,000 less 6,000, what will you get for this, please? 5 over 3 times 1,000. What is that going to give us? So even though the gain here is 3,000, you restrict it to 1,666 when the cost is 6,000 or less and the proceeds is more than 6,000. Okay. Now, when the cost is more than 6,000 pounds, but the proceeds is less than 6,000, you are selling the assets less than 6,000, but you bought it for more than 6,000. Then you are going to assume or capture the proceeds as equal to 6,000, meaning the gain will be zero and there will be no gain, there will be no loss. So if the proceeds is, let's say, 5,000, the cost is 6,000, the cost is 7,000. Okay, what you're going to do is that you're going to increase or assume this to be 6,000 and then this will be 7,000. So then the loss will be 1,000. Okay, that is what they are saying here. They don't want you to get more loss, so they are restricting you or reducing the amount of loss that you can claim. But when both the cost and the proceeds are more than 6,000, then you do the normal calculation when you have the proceeds and less the cost. Let's look at this example. So Maria sold the following assets in December: an antique table which had a cost of 3,000 pounds and was sold for 5,000 pounds. So in this situation, the cost is less than 6,000 pounds. Okay, and the proceeds is also less than 6,000 pounds. So what do? It becomes what? Exempt. Here, this one. When both are less than or equal to 6,000, it is exempt. Do we see that? Are we seeing that? Hello? Okay. So do I talk louder or what? Okay. The second one. The second. Now I'm just asking whether you understand the first points that we have solved. Okay. All right. The second one, the painting which had a cost of 2,000 pounds was sold for 10,000. So when the cost is below 6,000 pounds, but the proceeds is more than 6,000 pounds. So let's see what we have to do. Cost is less than 6,000, proceeds is more than 6,000. We're doing a normal calculation, but we restrict it to 5/3 of the gross. So let's calculate 5/3 of the gross less 6,000. So 5 over 3 times 10,000 less 6,000. So 6,666. So this is the maximum that the gain can get to. So let's like calculate the actual gain in the normal procedure. The actual gain is going to be 10,000, which is the proceeds, less 2,000, which is going to give us 8,000 pounds. So since the 8,000 pounds is more than the 6,666, we're going to stick with this one. Okay. Okay, let's come to the third one. An antique vase which had a cost of £8,000 was sold for £3,000. So here the cost is more than £6,000, but the proceeds is less than £6,000. So what we do is that we are told that we have to deem the proceed to be equal to £6,000 here. So here the calculation is going to be £8,000 is going to be £6,000, which is the proceeds. So it's going to be 6,000 less £8,000. So it's going to give us a loss of £2,000. Then the last bit, option 4, a set of china which had a cost of 7,000 and sold for 9,000. Okay, so the cost is above £6,000. Proceeds also above £6,000. So the normal calculation will apply. So we'll have £9,000 less £7,000. The proceeds is going to give us £2,000. Let's come to principal private residence relief. Okay, so this is a relief that exempts the payment of capital gains tax when a house is disposed of. Okay, now this disposal charge is when the owner of the house inhabits the building before it was sold. So if the owner didn't live in the house at all times or use it for business purposes, the relief will not apply in full. Now there are two types of exemptions. We have the full exemption. So when the building was fully occupied by the owner when he owned it till the point it was sold off. Okay. The second is when the building was not fully occupied. Okay. It was occupied partly when the owner owned it to the point where it was sold. Some periods were not occupied. That is what we call the partial exemption. So the partial exemption is the capital gains that has been estimated. Then you multiply by the period that the building was occupied. Okay, that was before it was sold. So the entire period of ownership, the number of times that it was occupied, divided by the entire period that the person owned it. That will be the amount of PPR that will be given against the capital gains. Okay. Now, there are certain situations where the house is not occupied, but it can be deemed to be occupied, meaning it will count towards the periods where the house was deemed to have been occupied by the owner and will increase the relief because any period that the house is not occupied, it will not be granted the relief. Meaning, if you occupy the house less than it was unoccupied, it means that the relief will be lesser. But if you occupied it more times, the relief will be more. Okay. The first of it is that the last 9 months of ownership before the house was sold, whether the owner occupied it or not, it will be deemed to have been occupied. So, for an example, the house was purchased on 31st March 2007. Then the owner lived in it for 2 months and then traveled the world, living in hotels until it was sold on 31st March 2024. So, if the house was bought on 31st March 2007 and he lived in it for only 12 months and the house was sold on 31st March 2024, okay, this is like 17 months. Okay, this is like 17 years rather. Multiply 17 years by 8. 17 years by 12, what are we getting? So you're getting 204. So this is 204 months. Meanwhile, he only lived in it for only 2 months. So ideally, only 202, only 2 months will be allow the relief. So it would have been 2 divided by 204 times the capital gains that we will calculate. That will be the only relief that will be given. But yet they are saying that the last 9 months, so in addition to this 2 months that he actually occupied it, the 9 months will be added. So it will be 11 over the 2 over 4. Okay. So the last 9 months of ownership of the house from 1st July 2023 to 31st March 2024 will be considered occupied by the individual, even though he didn't live in it. Do we get that? Is that understood, please? Okay. The second period where an absent house can be deemed to be occupied is any period that the individual works abroad. So his business or his form place of employment took him outside UK to work. Now, if the person works there for any amount of time, provided it is because of the business or because of his work, that is how come he's living there. The person lives there 12 years, 13 years. All that period, whilst he is on company assignment, will be deemed to be occupation. However, the only thing is that the person must return to live in the house until it is sold. So, if an individual purchases a house in London on 31st March 2009 and he lived in it for only 2 months, but then traveled to Barbados for employment for 4 years, and then he returned to live in the house until it was sold on 31st March 2024. What we are going to do is that these 2 months that he actually lived in will qualify for the relief. The 4 years that he was away due to employment, it will qualify because he returned to live in the house before he sold it. So this 4 months will qualify. This 4 years will qualify, which is 48 months. Okay. And then he returned to live in it. Yes, because he was in Barbados because his job took him there. And then he returned to live in the house before he sold it off. So if he had stayed there and then sold the house off, ordered somebody to sell their house off, then that 4 years will not qualify for the relief. You must return to occupy the house before you can sell. So the 48 months that he lived outside will be considered to be occupied. The third is any period of 4 years during which the individual is required to live in the UK due to employment. So the second one was job sending him outside the UK. But if the job moves him or her from where the house is to another part of the UK to work, if he works from any period up to 4 years, then the relief will be granted. Okay. If he's working elsewhere in the UK but it transcends the 4 years, then the extra of the 4 years will not be allowed. Okay. So if the person has a house in London on 31st March 2007 and he lived in it for 2 months and then moved to Newcastle, which is another part of UK, for employment for 4 years, and then he returned to live in the house, and he has to also return to live in the house. Okay. Then the capital gains purposes will allow the private principal private residence relief. Okay. So the 4 years qualifies for it because it is within the allowable threshold. Now, lastly, any period up to 3 years for any reason. So the person didn't occupy the house. It doesn't have any employment reason. It doesn't have any traveling reason. It doesn't have any reason. He just left the house and went somewhere else. That will be 3 years, provided the person also comes back to occupy the building. So you can move away for 2 years, no particular reason. It is not because your job was requiring you to move or you were supposed to move or somewhere. You just wanted to leave. Maybe you were traveling or maybe you were tired of the house. You wanted to move and renovate the house or something, but you must come back. But if you stay for more than 3 years, then you will be subjected to certain taxes. So if an individual purchases a house on 31st March 2007, okay, and he lived in it for only 2 months and then traveled the world until 31st March 2010. So 31st March to 31st March 2010 is 3 years. So he's still within it. And he also moved back to the house before he sold it off. So he qualifies for the principal private residence relief. Okay. Now, For the second and the third point, if the individual is not living in their main residence due to work and they do not return to live in the house, okay, but they continue to live where they are, okay, then the period will also extend once they come back to occupy it before they sell it off. So let's look at this example. Dolly bought a house on 1st April 1994 for £10,000. She lived in it for 3 months. Okay, so what we do is that the first 3 months, so we have occupied, then absent. So the 3 months will qualify as occupied because he was actually living in the house. Okay. Now she then worked abroad for 24 months and then came back and lived in the house for another 174 months. So this 24 months, it is because she had to work abroad and she came back to live in the house. Would that be occupied or absent? So we put the 24 months here. Okay. Now we are told that he lived in the house for another 174 months. So that is actual occupation. So this one is normally called the deemed occupation. He was not in a building, but because he met the criteria, it is considered as occupation. But this 3 months will be actual occupation. Okay. This 174 too will be actual. So put the 174 under occupied. Now, she then lived in the UK. She then lived and worked elsewhere in the UK for 48 months. So the 48 months living outside the house but working elsewhere in the UK. So Donny never returned to the house and it was sold 108 months later. So this 48 is going to be treated as absent. So we put it under the absent column just because she didn't come back to live in the house. And we're told that she never returned to live in the house and it was sold 108 months later in December for £150,000. Now, this 108 months, we know that 9 months which served as the last period before the sale. So the last 9 months prior to the sale, whether occupied or not, it is deemed as occupied. So this 9 months will be deemed occupation. We put the 9 months here. So now this 108, the 108 less the 9 months that has been taken out is going to give us 199. That will also be absent. Do you get me? Okay. So what's the total for the occupied? What's the total for the absent? So this is 210. Is 147. So the total ownership period is going to give us 357, which is the 210 plus the 147 months. Okay. Now, if you're supposed to calculate the chargeable gain, okay, the house was sold for proceeds was £150,000 and it was bought for £10,000. So the cost is £10,000. So the gain is £140,000. Then we take away the principal private residence relief. Okay, so this is going to be here. The total amount was 357. Okay, and 210 was occupied. So it's going to be 210 divided by 357 times the 140,000. What would that be, please? So 82,353. So what will be the chargeable gain? $57,646. Let's get another illustration. So on 30th September 2023, Jane sold a house for £400,000. The house had been purchased on 1st October 2020, 1st October 2003 for 167,500. Jane occupied the house as her main residence from the date of purchase until 31st March 2007. So, so the house was bought on 1st October 2003 and it was occupied until 31st March 2007. So this one, we were told he occupied, or Jane occupied it. So this is occupied, then absent. How many months would this be? We can do it in years and then we convert it. From 1st October 2003 to 31st March 2007. So to September 2004 will be 1 year, 2005 will be 2 years, 2006 3, 2006 3. Okay, so September, so 3 up to 2006 September is 3 years. So October, November, December, January, February, March, 6 months. 3 years, 6 months. So like 42 months. So 42 months is actual occupation. Okay. So these are in months. Now, we are told that the house was then unoccupied from 1st April 2007. So 1st April 2007 to 31st December 2010. 31st December 2010. It was unoccupied. Okay. But then it was due to Jane moving to Chicago for work. Okay. So how many months from 1st April to 31st December 2010? 1st April 2007. 1st April to 31st March the following year is 1 year. So 2008 is 1 year, 2009 is 2 years, 2003 is 3 years. So it means that from April to December is 9 months. So it's 3 years, 9 months. So 36 plus 9 is 45. So 45, we are told that she moved because she was working in Chicago. Let's see whether she came back to occupy the building. So from 1st January 2011, which is immediately after the period, to 31st December 2017, Jane occupied the building. So it means that she came to occupy the building. So we can give it to her as deemed occupation. Right? So we are saying that from 1st January 2011 to 31st December 2017, she occupied the house as a main residence. So that's actual occupation. So from 1st January 2011 to 31st December 2017, that is going to give us like 17 months, 7 months, 7 years, or 11, 12, 13, 14, 15, 16, 17, 7 years. So that's 84 months. Actual occupation. Okay. Okay. Then 17, main residence. Now, the house was then unoccupied until it was sold in 30th September 2023. So it means that from 1st January 2018 to 30th September 2023, it was not occupied. Let's look at the number of months now before we take the 9 months out. So this one is 9 months. Okay. From first, so we can even say from 1st January 2023 to 31st to 30th September 23 will be deemed occupation as the last 9 months of the period, right? So we can just restrict this one to 31st December 2022. Do you agree? Okay. So from 1st January 2018 to 31st December 2022. So that's 60 months. So that one, she didn't live in the house. So we were saying that the house was then unoccupied until 30th September. So here you realize that it is 5 years because she didn't come back to live in the house. Okay, the 3 years has been lost. Okay, if she had come back to live in the house, maybe from 1st January 2018 and maybe 2020 to 2020, then she came back to live in the house after 2020, maybe 1st January 2021, then 3 years will qualify her to be deemed occupation. That is one of the things that tax consultants will advise their people. She could have just come back to live in the house just one day and then go away. So maybe then three would have qualified her a PPR and a two will be exempted. But because she failed to come back, the entire 5 years, which is 60 months, will be deemed as absent. So what's the total here? And what's the total here, please? Okay. So total ownership period is 240 months. Okay. Now, calculating the capital gains, we have the proceeds of she purchased the house at once. She sold it for 400,000. So it's 400,000. Then the cost, we don't have any incidental cost of sale. So the cost is 167,500. So this is going to give us what? I think 232,500. 232,500. Good. Then that is a gain that is arisen. Then we charge a PPR from it. Okay. Which is going to be 180 was occupied. So it's going to be the 180 occupied less the 240 times the 232,500. That will give us 174,375. Okay. So the chargeable gain now will be 58,125. Capish? Nice. Now, here the building was used for residential purpose. So we only disallowed the relief due to non-existence or absenteeism. Now, if the building is not solely used for residential purposes, but it is used for business purposes, then we will disallow the part of the building that is being used for residential purposes. So after you have calculated the PPR, then you disallow the period for the business purposes. So in this illustration, on 30th September 2022, Henry sold the house for £155,000. The house had been purchased on 1st October 2013 for £100,000. Now, throughout the period of ownership, the house was occupied by Henry as his main residence, but one of the house's 5 rooms was always used as Henry's office premises. What capital gain arises on this disposal? So, here because he lived in the building throughout the entire ownership period, there will be no capital gains tax arising. So, if not for the business period, the proceeds would have been £155,000. The cost is £100,000. The gain is £55,000. So because Henry lived in the building throughout the period of ownership, the PPR would have been 100% of this gain. But because one of the rooms was not used for residential purposes, okay, we are going to disallow one. Okay, so the PPR is now going to be the 4 rooms used for residential purposes divided by the entire 5 rooms in the building times the 55,000. Okay, so this is going to give us 44,000. So now the chargeable gain is going to be 11,000, which is basically the private residential relief for the room being used for the office. Have you understand? Have you understood it, please? Okay. All this while we'll be talking about the individual living in the building or living in the house, probably with his family throughout the period of ownership. Now, let's say the house is a 5-bedroom apartment. It's a 5-bedroom house, and they lived in the building through the entire period. But then he has rented out one of the rooms. Then letting relief will come in. Okay. So what you do is that you will claim the PPR on the part that the owner actually resides in. Then the other part that has been let out, you claim a letting relief. That will also reduce your capital gain. So it's 2 gains that you are gaining. So the letting relief is the lower of the principal private residence relief that you calculate on the portion that the owner resides, and an amount of £4,000, which is flat. And thirdly, the gain attributable to the letting. So the gain here is the PPR that will be attributed to the room that has been let out. So when you have these 3 figures, the lowest of them is what you will choose as the letting relief. So that will be an additional relief to the PPR. Okay, let's look at this illustration. Susan purchased a house for £200,000 in 2001 and sold it for £350,000 in 2023. And throughout this time, she lived in the house as her only resident, but let out 2 spare rooms amounting to 25% of the property to tenants who had exclusive use of their rooms. So, what the chargeable gain after the PPR exemption and the letting relief exemption? Now, when we take the gain, the proceeds is £350,000. Then we less the cost, £200,000. That will bring us to the gain of £150,000. Okay. Now, if you're calculating the PPR, we are told that Susan occupied the house throughout the period of ownership. Meanwhile, it was only 75% that she used. So if she had occupied the entire space in the house, this 150,000 would have been fully exempted. But because she only occupied 75% of the house and rented 25% to tenants, the relief is going to be 75% of £150,000, giving us 112,500. So now we have to claim the letting relief. Now, the letting relief, we are told that it is the lowest of 3 items. First is the PPR, which we've already calculated, 112,500. This one. We also have an amount of 40,000 pounds. Okay. Then let's look at the gain on the letting. The letting is 25%, so the gain is supposed to be 25% on the 150,000, which will give us 37,500. Of these 3, which is the lowest? Which is the gain attributed to the letting? So the letting relief now will be 37,500. So the chargeable gain will be 0. Let's look at the disposal of shares and securities. So if somebody gives out shares as a gift, somebody gives out shares, capital gains tax will apply. So the steps involved in calculating this is that you have to value the shares using the addition of the lower quoted price and half of the difference of the higher and the lower quoted price. So when you get that value, then you multiply that by the number of shares being disposed of. Okay, so in an illustration, Megan gifted 1,000 shares in NPLC when they were quoted at 400 to 408 pence per share, with marked bargains on that day of 398p, 402p, and 407. So this one is not relevant in capital gains purposes. It's essential when you go to inheritance tax. So don't bother yourself on this. What we need to focus our attention on is this too. So you're supposed to calculate the value to be used for capital gains disposal proceeds. So first, we need to estimate the value. We are told that the value is the lower end, which is the 400, plus half of the higher end, 408, less the lower end, 400. Okay, so this is translating into 400 plus half of 8. Okay, it's going to give us 404p. That is the value of each share we have calculated. Then the step 2 is the total proceeds of the shares. So the proceeds of the shares is going to give us the 1,000 shares that Megan gave out multiplied by 404p. So 404p is equivalent to 4.04 pounds. So when you have 400p, just divide by 100. So this divided by 100 will give us pounds. Okay, so you move the 0.2 back. So this is going to give us, so when you multiply by 1,000, it's going to give us 4,040 pounds. Let's come to share matching rules. When shares are disposed of, a problem comes in when multiple shares have been bought over the period and you don't know which of the shares you are giving out. So you bought shares last 5 years, then last 3 years you bought another set of shares, then last 2 years you bought shares again, then last year you bought shares, then this year you bought shares, and then you decide that you are giving 1,000 or half of the shares to your child, your daughter or son. How are you going to determine which of the shares you are giving out to your child? That is the problem. So there's a share matching rule that helps you to determine the cost, because if you don't know which of the shares you are giving out, it will be difficult to determine the cost of the shares. So now there's a matching rule that will help us to estimate the cost of the shares that is being given out. So in as much as you cannot actually tell, this rule is going to guide us to find the shares, the cost of the shares, and then value it to get the capital gains. So this is what we call the matching rules. So the matching rules are done in the following order. So the shares that were acquired on the same day of disposal. So if you gifted the shares to your daughter on 1st January 2024, okay, any share you bought on 1st January 2024, you will use that purchase shares cost and attribute it to the shares that you are giving out. Okay. Secondly, if there is still need, or maybe the shares you give out is 1,000, but the shares you bought on the same day is 500, it means that it is left with 500 to cost. So you move to shares that were bought the next 30 days after the disposal on the first in first out basis. So if you sell the shares on 1st January 2024, you have to look out from 1st January to 30th January 2024. Any shares that you bought, you will use its cost to value the ones that you are selling on first in first out basis. So if on 5th January you bought shares at £10 each. You will use that one first. If it doesn't suffice, you move on to maybe 15 January and then on and on. After that, if you still need some shares to cost, then you go to the share pool. Share pool will be any shares that were not bought on the same day of disposal and it is outside 30 days of the disposal. Then you sum them. Let's look at this illustration. So Benazer owns shares in LPLC. So she acquired 1,500 shares in the company on 31st May 2021. So here we have shares and the dates. So she has 1,500 on 31st May 2021. Then for 20,000, so this is the value. Let's say this is the value of the cost for £20,000. Okay. Then she bought another 500 on 30th June 2020 for £10,000. Then on 7th March 2024, she bought another 200 shares. That is 7th March 2024. She paid 4,000 for it. So Benazer sold 1,000 shares in LPLC for 25,000 on 28th February 2024. So the issue now is that this 1,000 shares that she's giving out, are we going to take it out from this one, take it out from this one, take it out from this one? If you're taking it out from this one, that means that we are going to use the cost here. So 1,005, 2,000 divided, 20,000 divided by 1,005. That will give us the unit price of the shares, and we'll use that to value this 1,000, the 1,000. Okay, so that's the problem. So the share matching rule is saying that the first point is to determine, use the value or the cost of shares that were bought on the same day of disposal. So the disposal date is 28th February 2024. Do we have any shares that were bought on 28th February 2024? Okay, so the first rule is out. We didn't get anything. The second rule is shares that were bought within 30 days of the sale, post sale. So 30 days of 28th February is going to give us up to, let's say, 30th. It's giving us to 30th March 2024. Do we have any shares falling in that category? So this one. So the 200 shares, you realize that the 200 shares, each share is going to be valued at 4,000 divided by 200. Divided by 200. So each share is going to be valued at 20 pounds. Do you get it? Okay. And on that day, we only have 200 shares available. So we will value 200 shares at 20 pounds, giving us 4,000 pounds. Okay. Now we are now left with the share pool. So the share pool is saying that we don't have any shares bought on the same day as the shares that were sold, and we have shares within the 30 days. So the rest we pool them. So pooling means that we sum them. Pool. So we will have 1,500 going at 20,000, then the 500 going at 10,000. So the total number of shares in the pool will be 2,000 shares, and the total value will be 30,000 pounds. So the unit share, okay, so each share value will be 30,000 divided by 2,000, okay, which is 15. Okay, so the 800 shares that is left, okay, so this 800 shares, we are going to value it at 15 pounds per share. How much would that give us? So that will give us 12,000. So the total cost of these shares Okay, it's going to give us 16,000. This means that the share pool, okay, because the share pool is 30,000 and we have sold 12,000 worth out of it. The value of the share pool now, so the value of the share pool now, okay, it used to be 2,000 valued at 30,000 pounds, and we have sold 800 out of it at a value of 12,000 pounds. So now the share pool is now left with 1,200 shares and its value is 18,000. So when next a share is supposed to be sold, it will be taken from here. The value will be taken from here. So each share now is worth, each share will now be worth. So we have the 18,000 divided by 1,002. Each share is going to be 15 pounds. So we are asked to calculate the capital gain on the disposal. So for the 1,000 shares that were disposed of, the proceeds, the 1,000 shares were sold at 25,000 pounds. So we have 25,000 pounds. Then the cost, as we saw, is 16,000. 16,000 pounds. So the gain give us 9,000 pounds.